So Bruce, in more than 17 years managing the Fairholme Fund, you've had some ups and downs, mostly ups, but you've never underperformed by this much for this long.
Right.
So what does it feel? What does it feel like right now to be Bruce Berkowitz?
Well, to a great extent, my heart goes out to our shareholders, especially those shareholders who have lost faith. I mean, I understand that I would think there's considerable fatigue in the investment environment, but I mean, I felt this before. I mean, this is very reminiscent to me of right before the all things technology and telecommunications, that bubble bursting. When I remember talking to my wife saying, you know what, I can't go out to dinner anymore. If I hear another person tell me about what a brilliant day trader they are, or that they just made a huge amount on this darling or that darling, it was over. So the markets are not cheap. The markets are being sort of driven by a handful of companies. As usual, I'm invested in that which is hated or deemed to fail. And that's where I like to be. But as you rightly point out, it has been a long period of time, and I believe that our shareholders are going to see whether or not I'm right in the not too distant future.
Your style of investing, deep value, contrarian, concentrated, requires a high level of conviction. What's the secret to holding the course when everyone, if not everyone, lots of other people say you're sailing in the wrong direction?
Well, just because I'm contrary doesn't mean I'm right. So one of the elements is that I invest all of my money in the ideas. So I've always, from day one at Fairholme, have taken the view that I need to eat my own cooking, and I need to make it important, and it needs to be a significant business for me on its own. So I am doing what I think is right for my family, and by definition, I hope I'm doing what's right for my shareholders. And I haven't changed it in one iota since day one. I mean, at the Fairholme
Not one.
Fund. Not really. No, I've always known that the best way to invest is when it's most business-like. I've always wanted to be long-term oriented. I was, how can I put this? The saddest part for me, or the most difficult part for me in investing, was when I had to sell a position. You used to put so many years into studying a company and then feeling the need to sell an investment. It almost felt like divorce. But I really respect the idea that you can slowly buy an investment and hold it for many, many years and have the efficiency of holding it for many years. But I've always been value-based, and I've always been a balance sheet buyer. I've always bought assets at a significant discount to, I believe, the value. And usually you can only do that when companies have issues. But you have to determine that those issues are fixable. And then you have a situation where you have a price and you have a value, and you know that over time either the price is going to go to the value, or the value is going to come down to the price, or most likely they meet somewhere
They'll converge.
in the middle. And if you're really good at what you do, the value will increase as the price catches up with the value. But currently, I don't think many people think I have that ability.
Does it frustrate you, Bruce, that so much money is flowing into products like ETFs or quantitative strategies that require zero fundamental analysis of the companies they hold?
It doesn't frustrate me. I understand it. I mean, ETF investing to an extent is a good idea. The idea being, you benefit by the growth in the U.S. economy. As the U.S. economy improves, the markets improve, ETFs go up in value, and there's a direct correlation. But an ETF is only as good as the constituents within the ETF, and it doesn't take into account the sort of illogical extremes. There is a point where it makes no sense to buy an ETF, and it makes a point, the general markets are overvalued, or the highly capitalized part of ETFs are overvalued. So it does bother me that a lot of sort of blind decisions are being made, and thinking is being delegated to a sort of a mathematical equation that everything should average out okay over the long period. But last time people got caught up in this, they didn't lose all their money, but it took 13, 14, 15 years to recover from, not thinking about the valuation of what you're buying.
Are we at that point now where it doesn't make sense to buy an ETF because the underlying valuations are just too rich?
It doesn't make sense to me, but I'm not a growth investor. I'm not a visionary. I'm the guy who's looking to buy $1 for 50 cents, and if I'm wrong, I'll get my 50 cents back. If I'm right, I'll do a lot better than the dollar over time.
You're underperforming, but you're hardly alone. Why do you think it's so difficult right now for active managers to beat their benchmarks?
When the big problem is when you're an investor in public securities, people have to agree with you. In other words, I can be right, but until other people agree that I'm right, I'm going to look very wrong. And so what it takes for me to be right is for eventually for the companies that I invest in to fix the problems that are fixable.
But you're a value investor.
Yes.
There are lots of other active managers who aren't value investors, and yet they're underperforming too. Why is it? It's like a disease.
I don't know why, and I must admit, I don't pay a lot of attention to other people, and I try not to be biased by whatever's going on and whatever's doing well and so on. I just go by the math. I basically follow the cash. I invest at a discount, and I stick to that process, and as long as I still think the value is there, I stay with the investment. And normally what happens is the investment declines tremendously in value during my investment process, and then eventually the problems and issues are resolved, and the sort of clouds disperse, and people get a better look at the assets and liabilities within the company, and things work out well. At least that's been the case for 30 years.
I'm curious, when you look at the must-own stocks, the FANGs, for example, Facebook, Amazon, Apple, Netflix, Google, or some of the other high flyers like Tesla, say, or NVIDIA, what do you see?
I see companies that are priced for a very, very rosy future. And if it's a great rosy future, people will do well. But a couple of problems, and it's gonna be difficult for investors to recover over a period of time. But again, that is not my circle of competence, right?
I know. That's why I say for me, it's as much a matter of curiosity as anything else.
You've asked me about Apple's iPod when it first came out. I would have told you, I would never invest in it. The quality's horrible. The music's compressed. There are so many competitors. So it shows you what I know about the future. I'm strictly about the present and the past.
Your conviction, Bruce, was tested in 2011 when two of your principal holdings, Bank of America and AIG, cratered, but your investors were rewarded handsomely in 2012 and 13 when those stocks rocketed higher.
Right.
Are you as convinced now as you were then that the stocks you own today will demonstrate as much unrealized value?
Yes. The case of Bank of America and AIG, it was clearly that the company still had franchise values, had the assets, had the earnings power, and could recover. And even at the worst possible times, when it got so bad, both companies were basically selling for less than the cash they had in the bank. The problem with AIG was the government ownership of about 91% of the company. I remember going to the U.S. Treasury and talking about AIG, and and the re-IPOing of AIG, it just made sense. AIG had franchises. They had a couple of fixable issues that were fixed. And it ended up with the government with a record amount of profits for the taxpayers of the country. And shareholders had a chance to recover, and it all worked out well. It was a win. It was a win for all constituents. And it's no different with Fannie Mae and Freddie Mac. In fact, it's exponentially better for Fannie Mae and Freddie Mac.
Your holdings right now are concentrated into three groups: Sears and what I'll call the Sears extended family.
Right.
Fannie Mae and Freddie Mac preferreds, and St. Joe. If I describe that portfolio as a bet on three things: retail, GSE reform, and Northwest Florida real estate, would I be right or would I be wrong?
I think you would be right, but my focus from the start has been on the real estate, the physical world. It's been on as the margin of safety in the businesses. I'm not a retailer. I mean, I have great love for Sears. I think it's an iconic brand. Company. I want to see the company transform as a retailer. But I do know also in the back of my mind that from failed retailing comes great real estate empires. I think that we may be sitting in the physical location of a retailer in the past.
Alexander's.
Yes.
Was previously stood on the site of this very office tower where Bloomberg headquarters sit today. Used to be Alexander's years ago.
Yes.
But it took Alexander's to go away before this building could be built.
Right. Management of Sears are very, very sensitive to employees. They care about their employees. Sears still has a tremendous amount of employees. You have to do whatever it takes to keep the jobs as long as you possibly can.
Sears has had to cut thousands of jobs.
Yes.
Tens of thousands of jobs.
Yes.
To the people whose jobs are lost, it doesn't sound like the company is very sensitive.
It's a question of the jobs that remain. There's still a considerable amount of jobs that remain. And it's not easy, affecting families. You have to try as best as you can, but at some point you can only, you have to get down to a right-sized footprint, and you have to face, you have to face the realities of the market. But Sears, many businesses. Sears, there's Kmart, there's the Kenmore brand, the Craftsman brand, Craftsman by Sears now, Die Hard. There's an insurance company. There's over 100 million square feet of real estate. There's the working capital. There are many parts to Sears, and it's a tremendous asset base.
Right now, all of those things are priced at $7 a share.
Yes.
Roughly speaking. What do you figure it's worth?
At Fairholme, our internal valuation of the assets today is between $90 and $100 a share.
$90 to $100 a share.
Yeah, that's right. That we've been, people at Fairholme have been doing this for many, many years now. And sadly, our valuations have come down significantly because of the operating losses in retail, but there is still tremendous value with Sears.
So Sears is, as I'm sure you know, the most shorted stock in the Russell 3000.
Yes,
what do you see there that so many other people don't see?
That's exactly what the United States Treasury once asked me about AIG. That's exactly the question. They asked me two questions. Why do you own AIG? My answer was there's value. And then the second question that was asked of me is, why are you the only one to own AIG? And I said, I don't know. You'll have to ask everybody else. I mean, I've studied AIG for decades, and I understand the franchise, the global franchise there. It's the same with Sears. I can't explain it. The math is there. I mean, there's a psychology that the company is not capable of transforming, and I believe the company is going to prove those speculators who are shorting the company to be wrong.
Wrong on an absolute basis or wrong on a relative basis? Because Sears had issues before retail came under pressure. Now retail's under pressure.
Well, I think if you go back to the annual reports of Sears and what Eddie Lampert had to write, he saw this coming years and years ago. The companies had some very good ideas. The problem is they haven't been able to implement on those ideas, and that's been the big difference.
As an equity holder, the company has to be able to fix its problems for you to be able to realize the underlying value of the real estate assets and the other assets that you believe are underpriced.
The company has a very aggressive 2017 plan to reduce expenses by $1.25 billion, $1.25 billion run rate per year. Plan to reduce liabilities by over $1 billion this year. The company has made significant progress in doing that, as reported by the company. And the company will continue to take those actions, and it should become obvious to investors as they see the results flow through from those actions.
What if the improvements, this strategy, if you will, and the tactics through which it's being implemented don't result or don't produce results fast enough? Because that's been the case until now, right? The company continues to generate negative cash flow, continues to burn through cash, and clearly Sears and Eddie Lampert and you want to do something about that.
Right.
But there's no certainty that it's going to happen. If it doesn't happen and it continues not to happen, what then?
Well, if it continues not to happen, then the assets continue to deplete. But it has to happen. The time is for it to happen is now. There's a plan in place for it to happen now. And
but we could have said that 2 years ago.
That's true, but I think...
And in fact, we may have.
And I've been saying it for more than 2 years. But if you look through, I think there is a large sense of urgency. The pace is much faster. The company had good success in the selling of its Craftsman brand early in the year. And I believe that as the company, as the operating loss diminishes, and in fact the company makes money in its operations, it will be obvious to everyone the assets that remain. And of course, a good example of that is in Seritage. Seritage is 40 million square feet, and they are taking spaces that Sears no longer needs and taking the $4 rent per square foot that Sears is paying and recapturing the spacers and getting $18 per square foot, which is a fair market valuation. And Seritage has the chance to do that for many years.
But Seritage is the only member of the Sears extended family that isn't losing value. Land's End is down some 40%. Sears Hometown is down some 90%. Sears Canada, for example, which has been separate from the parent entity for quite some time, is down 90% in 5 years.
Yes.
Doesn't that say something about the quality of Sears assets? Because those were spun out as ways to realize unlocked value.
I think it says something about the perception that investors have of the various Sears pieces. Sears Canada, again, has valuable assets. They're taking a more aggressive tact, I would say, than Sears in the United States in trying to redefine itself. And we shall see. But same thing with Sears Canada, their value remains. The question becomes, there's an ecosystem between the asset values, brand values, working capital, and how you maximize that equation is not easy, especially in a very difficult retail environment. But there still remains tremendous value. And it's really now is the time. Now is the time that Sears Canada they have to show investors the value of the assets, and the way to show the value of the assets is to stop losing on the operating side.
That would certainly help.
Well, once that happens, the assets also become much more valuable. Because right now, even though Sears has been a seller of assets, and I would say to you, anything that's been transacted has been done at a very fair price. And further, the company it will not sell assets at unfair prices. It doesn't need to sell assets at unfair prices. And the sooner the whole ecosystem realizes that, the better for everyone. Because as you see today with Amazon taking over Whole Foods, I mean, there is value in the physical world. There's everyone, all the different channels merging together, this omni-channel presence. And everyone is going to have to merge into this ecosystem.
Well, let's take up that issue discreetly. What does Amazon buying, let me phrase it this way, what does Amazon buying Whole Foods say about Sears?
It says to me that there is a need for physical space in retailing. It says there is need to have tremendous locations. And I read the news headlines, and I was positive on Sears because of it, thinking that it reinforces my thought that the physical world is not disappearing. The physical space is not disappearing for retail. Malls aren't disappearing. They're doing quite well. They're all transforming back to what I would call village life, outdoor, indoor cafes, movie theaters, where you can have a sort of social community life and get everything done in one place. So you see the transformation of malls in good locations. People don't understand that the value, the real estate value sometimes aren't even in the building as much as it is in the parking lots, where if you have an anchor of a building that may have 8 to 12 acres of land, and if that is in a part of the world where there's no empty land like that, and it's tremendously valuable. You have a basic level of infrastructure already built in, with water, sewer, roads, highways, electrical grid, so on. It's very valuable. And there are thousands and thousands of acres which surround these anchor department stores. And don't remember, Sears was the builder of many malls. I mean,
so Amazon buying Whole Foods should help people revalue Sears assets.
Well, there's tremendous value in the locations, and there's tremendous value in cooperation.
Well, hang on a second, because that's a provocative point. Should Amazon buy Sears?
That would be an intelligent move. I think it's an intelligent move to buy Whole Foods. It's an intelligent move for Sears to work with others and for others to work with Sears when you consider the infrastructure, the systems, the logistics, and the other pieces that Sears has. There are a lot of pieces to the puzzle. And Sears is a great gateway for new designers, new companies to come into the United States to show their stuff. It's a great way for Sears has a logistics systems that can be utilized. Everyone is the competition's extremely tough. People are going to have to find ways to become more efficient and do a better job, and we're going to see it. And we're going to have to see with the supermarkets. You're going to have these mergers, amalgamations. It makes sense.
Do you have any reason to believe Amazon will buy Sears?
I have no reason to believe that.
But you believe it makes sense?
I believe it makes sense that various retailers are going to have to get together, various mall owners are going to have to get together. The math makes perfect sense to me.
If there was one mistake, Bruce, that you made on Sears, what was it?
Well, my mistake with Sears is the same mistake I've made with almost every investment in my life. I have suffered from severe premature accumulation, and I may have set the record with with the Sears investment, St. Joe. It's been 10 years. It's been approaching 10 years, and I'm still quite optimistic that it's enabled that the period's enabled me to own, for Fairholme to own large percentages of a company like Sears or St. Joe. And it's my expectation when these companies get it right, we will have a large multi-decade wave to surf.
Multi-decade.
Well, you know, just go back, replay the tapes where you see it all the time.
But before I get to St. Joe, I'd like to ask about Fannie and Freddie. What's the end game for Fannie Mae and Freddie Mac?
Well, first you have to review Fannie Mae and Freddie Mac. So they're basically insurance companies. Fannie Mae started in 1938. The reason was to make sure that there were affordable markets, affordable mortgages for Americans, and it was to help the country also get out of the Depression and get rid of the shorter-term mortgages. You know, God forbid, if your short-term mortgage matured during a recession or a difficult period, and banks were running away from the market, you had nowhere to go. You were repossessed, and you have all the stories about that in the 1930s.
I don't think anybody would dispute that Fannie Mae and Freddie Mac served a purpose when they were founded, and serve a purpose today. The question is, what happened to them?
What happened to them?
What happens to them?
Oh, what happens to them? Well, what happens to them should be what happens to all other companies that make $15 billion plus a year.
Which is?
Which is they should continue as private companies. You have to play the tapes back. The previous administration was very worried about the global crisis and the market and the debt of Fannie Mae and Freddie Mac, which Chinese and Russians had significant amounts of, and they thought it was a good idea to put the companies in conservatorship. Companies, in my opinion, didn't need it. I'm not fighting that issue. That's what the board of directors at the time decided. And they were put into conservatorship.
And now all the profits are getting swept into the Treasury.
Right. But in 2012, when the sun was shining and it was clear that the companies were going to succeed, the previous administration changed the deal. And they changed the deal. Instead of the companies having to pay 10% interest, they came up with this everything interest dividend, where you just pay us everything, and you can never pay back your loan. And that was after already taking the right to own 80% of each company for zero, and after taking $1 billion from each company in banking fees.
I understand why you're aggrieved and why other
why should it stay?
shareholders are aggrieved.
It's fair.
Well, why should it stay that way? Because the path of least resistance is the easiest thing. The companies are working.
Right.
The housing market is working. And because of that, most Americans don't care. And if you ask them, I guarantee you they don't care about the interests of a bunch of wealthy investors. And that's who they see you and Bill Ackman and John Paulson as being.
Right. I understand they don't see through to the hundreds of thousands of clients and retirement funds and so on. So I understand that. I understand it very clearly. The reason why it's going to continue is it makes the present situation makes no sense. The Secretary of the Treasury wants them out of the government. They want less government. The new administration wants less government. So here we have two companies. They've paid back all the money in full. The taxpayers have made $80 billion. And what's going to happen now is, as the government sells the 80% owned by taxpayers, there's a $100 billion gain to be had for the taxpayers of this country by selling the 80% of Fannie Mae and Freddie Mac.
You describe that as a when.
That's a win.
I would describe it as an if, not a win, I'm sorry, as a when. When the government exercises its warrants for the 80% and sells that stock, yes.
Right.
Under that scenario, which is outlined in a plan I know you like, the MOLIS plan, the taxpayer probably would profit on the sale of that stock. But that's as opposed to the taxpayer continuing to profit in perpetuity through the net worth sweep.
But that would create tremendous taxpayer risk.
How so?
Because the taxpayers will be on the hook. There's no private capital. If during the next recession, the taxpayers will be fully on the hook for the capital of the companies. See,
That's why you support the recapitalization before
and
the
I
release.
support it because the companies have a history of creating tremendous taxpayer gain with private insurance capital. They've created tremendous billions and billions of gains for homeowners with private capital to insure the mortgages. And when these companies stick to their knitting, which they are doing now, conventional conforming 30-year mortgages, and their mortgages given to people who can afford to have a mortgage with significant down payments and with income coming in, and you stay away from the liar loans and the no docs and the teaser rates and everything else that went wrong in the past financial crisis. You have two companies who do great service. And when you go back, these companies have always generated cash. They have never been in an insolvent position. And it's one of the few examples, like electric utilities, where there's a public-private partnership that does tremendous good. And frankly, there are no alternatives. There are no alternatives. People can talk about alternatives, but there are no viable alternatives to diminish taxpayer risk, get private capital back into the market as a buffer against taxpayer risks, and let the public continue to earn billions and billions of dollars.
Bruce, you had a dialogue with the Treasury Department over AIG. Have you had conversations with Treasury since Secretary Mnuchin took office about the MOLAS plan or any other potential GSE reform?
No, we had conversations with the previous administration. I remember when in 2013 the net worth sweep started, had some dialogue about, let's get together, resolve the issue, let's create a win for everybody. And the response was, well, why should we?
Well, what about now? You have a Treasury Secretary who has said he's favorably disposed toward some kind of resolution. Why not strike up a dialogue with him?
I've read in the papers, I've watched on Bloomberg. Treasury Secretary said, we need to take care of health care. We need to take care of budget deficit issues, tax code. That's the agenda now. In the second half of the year, we're going to address Fannie Mae and Freddie Mac and get them out of government control and do what's best to reduce risks for taxpayers. Let's get the taxpayer risk out. Let's get them out of government control. There is no substitute. There's no alternative.
Isn't recap and release as a concept dead on arrival if the FHA director, Mel Watt, doesn't support it?
Well,
and he doesn't.
It depends what you mean by recap and release. No one's really defined those terms. Is the core of Fannie Mae and Freddie Mac focused on the conventional, affordable mortgages, which form sort of one of the foundations for the great American dream and allow people to save for the nest eggs, for college education for their children, maybe pass on a few dollars at the end of the day? There's really no risk to the taxpayer in that, and there's no reason for them to be part of the government, and it's worked out really quite well. Again, once you get rid of the false narratives, the companies have had a history of tremendous taxpayer gains with very little taxpayer risks. So this recap release, this notion that these companies have cost the American public a lot of money, it's absolutely been the opposite. So does it make sense for IBM to be a private company? Does it make sense for Fannie Mae and Freddie Mac to be a private company? Does it make sense?
But this is politics, right?
Well,
what's sensible and what's feasible in Washington frequently don't intersect. If the government, I say that broadly speaking, to include the executive branch, to include the agencies, to include Congress, if the government doesn't do what you want, where do you go?
If the government doesn't do what I want.
Which is to say, if the government doesn't resolve this issue with Fannie and Freddie, do you go to the Supreme Court?
We go to the Supreme Court, absolutely. But because when you go back and think about it, right, there are issues of breach of contract. There are constitutional issues of how do you create an agency that oversees Fannie and Freddie that doesn't answer to any branch of government? How did you let an acting director run the place for 3 years and then decide on a net worth sweep? And the person was supposed to be appointed by the president and approved by the Senate, and it never happened.
But other courts haven't found in your favor. Why should the Supreme Court see things any differently?
We've never argued the constitutional case yet. We've argued that the process was wrong. We argued that there was a misinterpretation of the law. How can there be a law that's hundreds of pages and it basically says that a government agency can do whatever it wants, whenever it wants, and
was that a mistake? Should you have argued it as a constitutional case?
Yes, that we should have argued it. It was so obvious that we argued the finer points.
So,
well, think about it.
So that's the next step.
Yeah, think about the original case that we lost was Judge Lambert, who said, basically, I read the law, and the law says to me that the FHFA, as conservator, can do whatever they want. They can take the money, they can burn it up, they can give it to a relative. It doesn't matter. That's what the law said. And don't blame me for interpreting the law this way. Go to Congress, who wrote the law. Okay? And he also said, and by the way, you didn't ask me if the law was constitutional. So now we go to the appeals case, where 2 of the 3 judges basically say, well, we agree. We think the law, as written, with the word may, we think that the government may do whatever it wants to do, whenever it wants to do it, without recourse and without judgment by the courts, by the administration, or by Congress. So one judge, the dissenting opinion said, basically, Judge Janice Rogers Brown said, I'm sorry. I think the quote is basically, America, to paraphrase, America is not a banana republic.
But she was in the minority.
She's in the minority. That's
so
correct.
I guess what I'm trying to understand, and what your shareholders would love to know, is how does this play out? When do you file a complaint with the? I don't know what the mechanism is, and even the process. How long does it take you to get to the Supreme Court?
It's a long process.
Are we talking years?
From beginning to end, it could be a 10-year process, and we're 5 years into the process.
Could be 5 more years for resolution.
It could be. It could be.
Let me ask you about St. Joe. I see St. Joe as Bruce Berkowitz's field of dreams.
Right.
If you build it, they will come. Is that right?
No. I am focused on, as I am always focused on, tangible values and what potential downsides are. Okay. Is it possible that this could be work out to be a great dream? Yes, it's possible. But what I see is the last great open place in Florida on the Gulf Coast, between the Gulf Coast and a brand new airport, with a company that has the entitlements to build 120,000 homes and tens of millions of square feet, and in a very tax-friendly state, where it would be a great place for jobs, for community, and it's happening. It's taken a long time. We've taken a company that's been around for a very long time, and we have transformed it to a company that's net debt-free. In fact, has $400 million of liquidity. A company that has less than 50 employees now at the headquarters, with very, very low fixed expenses, and a company that has over 100,000 acres of contiguous space in a beautiful part of the world.
So it's a compelling thesis, but we're not talking about Midtown Manhattan, right? An empty lot in Midtown Manhattan. This could take some time to play out.
Right.
How long?
Well, remember, the investment process is giving versus getting. So you have to take a look at the value of the company and what it's worth. So, for example, at St. Joe, the entire value of the company, the enterprise value of the company is probably $800 million. So what does $800 million buy you in Manhattan? One lot?
A small building, a Class B office tower.
Okay. So that, it's give versus get, right? I mean, how did Fort Lauderdale start? How did Miami start? Yes, it's true that when it comes to real estate, you're going to do very well, but you don't know if you're going to do very well or your children are going to do very well. And there is that time element, but St. Joe is building up a critical mass now. We are our first international manufacturer, GKN, defense aerospace. We have another tenant who is building the next generation of Coast Guard cutters, trying to build STEM schools. We have hospital systems coming in. St. Joe before was a builder at first of resort communities. Then St. Joe looked to be a builder of active adult communities, whatever that may mean. But when you look at St. Joe, the land is so vast, the geographic location is so good that St. Joe needs to be much more than that. It needs to be the area needs to be a major employer with high-tech jobs.
So what's the catalyst going to be? I know that it may take, and you've acknowledged that it may take a while for all of this to come together. But your investors and the market looks at the stock where it is today, 17, 18 bucks.
Right.
What it cost you to buy, something in the high 20s, and wonders, what's the catalyst going to be to at least get it back up to the high 20s? Can you see that in the near term?
I can't see anything in the near term. And I think I've proven that. But what I do see is a company building value. And people are going to have to decide for themselves what they think the exact value of St. Joe is. St. Joe is in a very good position with the liquidity, with very low expenses. St. Joe is going to do well in bad times. St. Joe is going to do well in good times. Okay, it's liquid. It could take advantage of whatever economic environment we're in. But St. Joe is dependent upon the stars aligning. And the old St. Joe, when times were very good, would, in my opinion, waste a lot of money. And when times were bad, they had to burn the furniture to stay warm. Today's St. Joe is the exact opposite. We can sit, we can be very patient, we can make sure that everything we do adds value to everything else that we have. And we can make unbelievable coastal communities and with high-tech jobs and with educational facilities.
Two quick questions, Bruce, before we wrap up. You mentioned liquidity. Morningstar has flagged Fairholme for liquidity risks over the size of your GSE preferreds, the Fannie and Freddie preferreds, versus the assets in the fund.
Right.
Is there a liquidity risk? Well,
they flagged us for a liquidity risk with AIG before. Then there was the liquidity risk for holding high-yield debt. I don't know how you have a liquidity risk when you have cash in the 20 25% range. It's hard for me. And when you look at how much smaller the funds are, and you look at my position in the funds and the very long-term clients in the funds, I don't really understand what they're talking about.
Well, they're talking about outflows. They say that if the outflows continue, you're going to have to raise cash by
well, I'm
selling
not selling
holdings.
My position. So that takes care of 10% of the outflow. Fannie Freddie, it's a big position. And by the way, we've sold hundreds of millions of dollars of stock in Fannie Mae and Freddie Mac. It's made some money. It's made some money, and I expect it to make significantly more. So that's probably an issue that that Morningstar will continue to flag when Fannie and Freddie continue to do well. And I understand that AIG was a 60% position for the fund at one time. When you go back early in my career, I had 2 companies in the entire portfolio. Again, Fairholme has not changed since its first day. We focus on our best ideas. We're long-term oriented, and I clearly have a history of buying too soon and selling too soon.
One last question for you. You've told me before that diversification is dumb. Why own your 5th best or 6th best idea when you can own more of your very best idea or your 2nd best idea? If you could own more of one stock right now, what would it be?
If I could own more of one stock today, given the portfolio, If I could, it would be St. Joe.
Really? That says something. Bruce, thank you very much. It's been great talking to you. Thank you.